One day I was accidentally brought into a lecture by somebody whose name sounds very strange to me. This is the first couple of years since I arrived in America. English wasn't quite there. And the name sounds like a free lunch buffet type of thing. Anyway, but that lecture by Buffett really fundamentally changed the trajectory of my life in America and really gave the career that I enjoy immensely today. And so it gave me a great pleasure to be back into this type of a setting to communicate directly with the student. Now today I want to talk a little bit about the value investing. The basic concept of a value investing obviously is many, many decades old. But today I think it is as relevant as when it was first laid out by Benjamin Graham at Columbia 6-7 decades ago. There's essentially just three basic ideas. The first one is that stock is not a piece of a paper that you trade, but is a representative fractional ownership of a company. And therefore, valuing a stock ought to really have a basic variance of valuing the company as a whole. And then secondly, that in valuing any financial asset, that you have to really predict the future, the discounted cash flow of the future cash earnings. And the future is inherently difficult to predict. And therefore, you really want to leave yourself a margin of safety so that you could be wrong or you could be right. But because the future is a distribution of opportunity, of statistic possibilities. Say you bet on something that at 90% of the chances you could be right, but then a 10% chance occurred, and so all of a sudden it become 100%. So you want to leave enough of margin of safety. In other words, you want to buy at a low enough of a price, even if all the adverse events occurred against you in the future, you will still be in the game. It doesn't mean you won't lose money, but it just means that you will not lose so much that you'll be out of the game. Because investing is really a long game. It can play over the life of anybody's career. And so you want to be really in the game somehow over the long haul. And the third concept is Mr. Market, to figure out a frame of mind to think that when the market is against you, you really look at it as a neurotic Mr. Market that's prone for emotional and irrational behaviors. So those are the three basic concepts. At the heart of it is obviously it is this bargain idea that you want to really get what you pay for. Now, obviously that's what everybody wanted. And if everybody wanted the same thing, you would think that all of the professional investors will be value investors. And that's just a furthest thing from the truth. In fact, value investing, as is properly practiced, constitute a tiny small minority of all the investment professionals. Majority of the people hold different views. And let me just articulate for them the alternative views about investing. Number one, yes, stock legally represent the fractional claims, the fractional ownership, but is first and foremost a piece of a paper you can trade all the time. And therefore, it follows that successful investing lies in the successful guessing of the stock movement based on whatever informed theories or practices that you can find. And thirdly, that the market is to be respected, indeed to be feared, because they really, through the market, you can actually find a value, and through the market, you can actually buy and sell. So this, here you go, a different view, and it sounds even more persuasive than the first views that I laid out as a value investor. In fact, I would say majority of the people really follow the latter rather than the former. So as a young student trying to get into the business, which way do you follow? I would suggest that before you do that, you would go to some fundamental studies as to the result of various different approach and philosophies. Unfortunately, there has been numerous studies have done because we kept a pretty good track record over the last 100 years at least. And all the studies have given an unmistaken conclusion that the true value investors, as it properly practiced, have consistently outperform the market, whereas just about all other strategies either match the market or severely underperform the market over a long period of time. Now you can dispute the result of it, but I think the evidence is pretty persuasive. And so the question becomes, if that were the case, of course, the study also concluded that the true value investors, that is properly practiced, really are a tiny small percentage of investing professionals. And it's also a very interesting study, but it really do conform our day-to-day observation, having been in this profession for close to 20 years. So why is the case? Why is the case? If the empirical studies conclude overwhelmingly that going through the value investing is the way to go, and the philosophies and the practice are being well articulated for 7 decades and well practiced and indeed publicized by tremendous successful examples such as Mr. Buffett, as we just mentioned, why not more people follow what they do? Well, it turned out it has a lot to do with human psychology. In value investing, you have to have this frame of mind that if you did your work correctly and the market against you, you should be comfortable standing alone. And this is the concept behind Mr. Market. But that's really very difficult to do. Indeed, it is a very unnatural thing to do. When the whole market is against you, when everybody else really think you're stupid and neurotic and wrong, and you now tend to think everybody else is a Mr. Market, irrational, neurotic, that is very, very unnatural things to do. It was the borderlines of a self-delusion. Indeed, that's probably most people's view about you at the time. You look quite ridiculous and very uncomfortable. In fact, our very evolution requires a certain deal of conformity. Think about over the millenniums, over the millions of years of evolutionary past, our ancestors, our animal predecessors, basically hunting groups. And if one was left out and disagree with everybody else in the group, very easily that one is not the one to survive. So all the genes that have survived in the past are the ones that tend to extreme degree of conformity. And conformity also works very well as for human society, because we are, at the end, at the heart, as social animals. We need that sense of glue of conformity and sympathy, compassion to bring the society in peace and live together. So you need a certain mutated genes, in a sense, to be utterly comfortable to stand alone when everybody else disagrees with you. Now that is the reason, at least that's one of the reasons, the financial market in itself is not that efficient. Free market, ever since it was practiced in modern time about 200-300 years ago, has worked remarkably well. But it's worked most remarkably well primarily, I think, in the goods and services, physical goods and definable services. We have several hundred years of overwhelming evidence to support that one. Every country we practice that one all turn out to be extraordinarily prosperous. Now we also have several hundred years of history of free market as a practice in the financial market, full of disasters, up and down, and extreme movement. It doesn't really work nearly as well when it comes to financial asset. Why is it? Well, the financial asset, at the essence, is a discounted mechanism to predict the future. It's the discounted, estimated cash earnings into the infinity. And of course, we all know, A, we cannot predict infinity, and B, we can't even predict immediately beyond what we can see, which is usually very short. And so there's a necessary elements of a speculation and guessing, estimation, into evaluations of financial asset. When that is exaggerated, there is an element in the stock market and the financial market in general, the element of a gambling, element of a guessing, element of a speculation. And as we all know, in pure casinos and pure gambling, there is a huge advantage stock against players and really to the benefit of the casino owners who define the rules. And this is why gambling is such a profitable business. And yet that has never really persuaded the people away from gambling. There is a certain element that really fit human nature to love gambling. Even if everybody knows the odds are stacked against them, that has never prevented gambling from a very big business, especially when it's allowed and sanctioned by the government, such as a practice in Nevada or Macau and certain different geographies around the world. And so there is some aspect of that one in the financial market as well. And this is the reason why that it does not work perfectly well, as recently illustrated by the 2008-2009 financial crisis, which is only in the stream of a long history of financial crisis. But it doesn't really mean that we have a better way of dealing with that. So it's just as Churchill said about democracy, is perhaps the worst except when compared with all the others. And so is the market. So is the free market when it comes to a financial asset. It doesn't work very well. Certainly doesn't work nearly as well as goods and services, but it's still one of the better ways we have come up with in terms of facilitating the flow of financing, which is vital for the workings of modern economy. So it works. So that really is to give us the challenge as a value investor, a true value investor. You just have to really refrain yourself from betting too often, knowing that the financial market doesn't really work too well, but a lot of the time it works reasonably well. And so you want to really wait for the extreme situation before you can really make a bet, so that you have A, enough of a margin of safety, and B, that you can actually stand against the whole market. That do happen. That requires an extreme discipline of demanding a large amount of margin of safety. Virtually all the successful value investor practitioners really have all that element in common. They do not bet often, and whenever they bet, they require a large amount of margin of safety, so that they will be comfortable in case the market moves against them. And so that they are seizing the opportunities that almost no-brainer. And that really is the most difficult challenges. Most people really do not really have the necessary discipline, mental discipline to do that. And so you would say that in the bull market, everybody at least would call themselves value investors. They buy something, they think there is a 20% discount to what they think is an intrinsic value. And when it goes up, they really trump themselves as a successful, intelligent, and value investor. But then the market really against them, which is very easy. 20% of discount is almost within the margin of error. If the market began to, and you would say that would be the first one, respect the market and run. That's typically the case. So when you see a situation like that, that is usually a sign that it's not true value investing as is properly practiced. So as a young student and a young analyst or somebody who's interested in finance, I would strongly encourage you, the best way to study the successful practices in real life and examples or history, but studied very well all the examples of the great value investing decisions. I was talking to Asner on the way from the airport to pick me up, so we talked about his favorite stock in Russian oil, which reminds me of one of those great examples of value investing back in the early 90s. As some of you might know, in the early 90s, Russia went through a shock therapy and went into free market almost overnight. In a short period of time, they privatized some of the most prized state asset, including local oil and gas property you talk about. And it was so short that most people don't really understand what it's all about. A lot of the people who work in the companies and also ordinary citizens were given certificate about that can really convert it to stock ownership, but most people really don't know what it is. So anybody who come along offer them a real cash, which they recognize, they were just afraid to give it away. So as a result of those certificates, at one point it was trading as an extraordinarily low prices. How low is the prices? Forget about the earnings. Just the sort of the asset on the balance sheet At the time, the oil prices, I think in the 4 or 5 year average, around $20. And the reserve represented by the balance sheet per share basis value value of the oil per barrel of the proven reserve at really low prices. Do you remember what was the price? Anybody remember? It was $20 per barrel traded on the open market. Anybody can imagine how low did it go? 1 cent on the dollar. Sometimes half cents on the dollar. In other words, about 10 cents to 20 cents per proven barrel of oil on the balance sheet. And that's not even counting the earnings from the company. This is how low it went. It was ridiculous. Now, I thought at that point that that's some kind of a margin of safety, even consider the political situation in Russia. And it ultimately traded up, for a longer period of time. It was at 20, 30 cents, 50 cents, and it gradually moved to $1 and briefly traded to $3. And then a few years later, the Asian financial crisis occurred, and the Russian devalued the currency. So all of a sudden, the $2 oil no longer looks very protected, because the currency literally at one point it went down 90%. I mean 90. But if you really bought it at the 10 cents, which is a half percent of the value, less than not the 10%, the value currency down 90%, you still came out quite all right. In fact, you still probably made it 10 times your money. That's how an extreme situation can become. That would be a good example to study. So that you can really withstand a situation, external shock, that really shocked one of the measure of value, in this case currency, by 90%. You still came out on top. That is how extreme it is, that concept of margin of safety, when you do practice. Take another example, a few years afterwards. Back in 97, 98, the oil in the open market worldwide traded below $10 for a period of several months. At the time, the 5 year average is probably 20, as I said before, but also the majority, actually if not all of the productions on the West, is above $10 cost. ExxonMobil, BP, you name it, everything outside Saudi Arabia, a couple Gulf state countries, and part of Russia. Part of those is small portion. It's not that small, but it's still a fraction of the overall production. Everybody's become unprofitable at $10 per oil. And at the time, we have not really figured out how to replace oil. And so there were plenty companies at the time not losing money, even at the 10. And who's really making a great, and who has a huge amount on the balance sheet. And you can calculate as to what it is amount to per share. And so there's really examples after examples after examples. So in every period of time, since I was in business, this is from the mid-90s, 94, 95, nearly 20 years, I've never really go through a period of time that I couldn't really find something just enticing and interesting. So if you especially operate a smaller pool of the money at any time, because you're really kind of choosing from 100,000 different securities, mostly stocks, all over the world, there are always opportunities like that that give you plenty of margin of safety. But of course, the most interesting thing you want to do is not only you're talking about the asset, you're talking about an enduring, earning, generating franchise, a compounding machine, in other words. If you can combine the cheap prices on the asset with also the quality of the asset, the ability to consistently generate cash earnings on a compounded growing basis, that is the holy grail that you can really hold for the longest period of time. And no matter what the market really for against you, you can really basically ignore it. Now, does a situation like that exist? I would argue it does. Maybe not for the larger amount of capital, but a smaller amount of capital. If I were a student today and it has a few tens of thousands of dollars, I'll be really very happy to live in the environment as it is today. Now, if I have a larger amount of money, we have multiple challenges all over the world, which we cannot really go into today. But if you have a smaller pool of money, there are tremendous opportunities like that in all small pockets. I'll give you an example that you can really do more work to see whether it's interesting. In Korea, there's a form of the securities, the preferred securities. Essentially, it is a non-voting common stock that pays slightly more preferred dividend, not much, but it cannot vote. But for interesting reasons, that they are treating sometime up to 70-80% discount to their common equivalent. And in that group of securities, there are several companies that really have enduring franchise that have been growing earnings and revenue on a compounded basis for over 3-4 decades. Because the franchise is nearly as a fortress, fortress-like. Great earning power machines, and they still have a lot of opportunity of expansion. And trading at prices that is essentially just a tiny fraction of what it really should be worth in an open and a private transaction if you buy the whole company. In fact, you have really a comparison of the common stock, the voting common stock equivalent. A situation just like that really exists even today. There's absolutely no reason, especially some of those companies that I talk about it, the family really controls the voting of the common anyway. So there is virtually no differences between the common, voting common and non-voting common. There was virtually no differences. And yet the trading was at 80% discount. I'm not talking about 20% discount, 80% discount. Trading at 20 cents on the dollar if you believe that that common value reflects the true value. So the opportunity, that my point is, really existed on all the different ones. So if you're starting your career, if you're young, if I were you, starting all over again, I would first study all the great examples in the past in which market went to the extreme on a small segment of securities that give you a tremendous margin of safety. Now, all sorts of things happen, and you'll still come out okay. Even if you lose money, you're still in the game. Study that one, and then study what is available today. And at any given time, there are always opportunities like that. And really it has something to do with our fundamental human psychology. As long as human remains the same, which I suspect we will after millions of years, that opportunity exists, which is quite an encouraging sign for young people. So if I were you, I would be very excited today, as I was when I was sitting in the audience in your shoe about 20 years ago. So good luck for that. Now I open for questions.
Yeah, I have a question. How do you decide when you sell the stock?
Well, that's a very interesting question. Now, depends what's the source of your value. In some of the example that I stated, the source of the value, it really is the asset value. And in that case, you really want to really reevaluate your scenarios upside and downside every once in a while because the situation changes. For example, in your favorite stock in the Russian oil, the local oils, and Gazprom, I sold it 2 years after I first bought it. And but at the time, they're still kind of treating probably 90%, 80 to 90% discount. But I think the 80-90% discount is warranted somehow. Today, they're still trading at a huge discount. I don't know what it is. You're probably more updated than I do. But relative to all the other countries, that I would feel less comfortable with that discount. I need more. And it just happened to be given a 99% discount, 99.5% discount. That was a fluke. Yeah. Now, if you're really talking about earnings, I tend to be less in a hurry, because if you really bet it right, the earning will continue to grow. And every time you sell stock, you basically take out essentially a 30 to 40% of interest-free borrow. By not really selling the stock, you avoided paying the capital gain taxes. The state and federal together is somewhere in 30 to 40%. I think it's going up. And as long as you're in that, in the sense you're borrowing from the government on the interest-free and risk-free basis, and if the underlying asset continue to grow on a compounded basis, I would say that is a reason to be less in a hurry to sell. If they reflect in the fair value, I would keep it. But if they really go to the extreme overvalue situations and the business environment changes, of course you do change your course of action. And that's a good thing about investing. Everything related and affected investment, all the circumstances changes all the time. That's why the game is so fun.
Yeah, hi. I was wondering, what is the margin of safety that you look for before you decided to buy?
Yeah. Again, that has something to do with the quality of the asset you're buying. If the quality of the asset is very high, your demand on the asset basis is low because you are demanding that margin of safety on the upside in terms of the earning generating power. Whatever it is, you have to have an insight as to what this asset can generate for you. And somehow it is somewhat of a different insight, a unique insight. Whether you know the business particularly better than anybody else's, if you really buy into the future earnings, or the asset, for whatever reason, you can withstand the balance sheet better than the other people. You have to have a better insight as to what is the appropriate value. And therefore, it may not really appear to other people as a large enough of a margin, but in your mind, you have a very, very large margin of safety. In my own case, I just think that the larger you can get it, the better. You want to have a very, very large margin of safety.
Right. So how about assuming that you have no insights whatsoever as to what the future earnings power is, and you just assume that it's a no-growth business, what would you pay for that business?
Well, in the case of that Russian, since I know very little about Russian, I have every reason to be suspicious. So that goes to 99%, and I get extremely uncomfortable when it goes to 80%, for example. And in the end, actually that 90% evaporated because of the currency changes, although it came back. So in each situation is different, but in the environment, I understand the external forces. I understand the management. I understand the general business practice in that particular culture. You would probably, 70, 80% is actually pretty good. It's all situation specific.
Okay, I just have to say that that's a pretty high hurdle rate.
Well, that's why you don't have to, my hope is you don't have to swing a lot. One of the key of a success for being a long-term successful investor is you have to endure a long period of time in which you do nothing. You don't have to do a lot in order to be fabulously rich and prosperous. That's the good thing about this game. You study all the time, but you don't have to do anything. And every time you do, when you don't have enough margin of safety, you can come out really losing. And that's really much worse thing than really than doing nothing. But every time you do something, if you have large enough of margin of safety, your upside is also becoming huge. And there are many, many examples, and I wouldn't have time to go into it, and in which when you turn out to be right, the upside is just enormous. It could really surprise your wildest dreams. And you want to wait for those fat pitches most of the time.
Okay. And then lastly, how much cash are you holding now? Thank you.
That is different from time to time. It depends on the opportunity. Yes.
I'm Jenny from Berkeley. I'm curious to hear your opinion on what you think are the domestic industry segments you think are most overvalued and undervalued today.
Well, there is, as I said, that to be a successful investor, you don't really have to know everything. You don't have to be who claims he knows everything, every stock. In fact, that if you truly know something, you really fall into a small circle. What Buffett Munger would like to call the circle of confidence. You would find in your circle, that circle tend to be small. So every time you hear people talking about, oh gee, I think that industry is overvalued, this industry is undervalued, that is not intellectually honest to me, at least. Investing, the last thing you want is to have that air of arrogance might be a too strong word, but I think the more honest you are intellectually, the more prosperous you tend to be. I have never intellectually arrogant people who can successfully practice the game of the investment.
First of all, thank you for coming. You talk about finding great financial dislocations to try and find these tremendous upside situations. Would you maybe expound on your research, like how you find these great dislocations where things are trading at 10% of what they're worth?
Well, I find, as I look at my own career, of all the ideas that I find, they really tend to come from all sources. I don't have a particular rule where they come from. If you have a curious mind, if you study all the time, and you maintain a good network of relationship with other smart, intelligent investors, and have a way of really looking into what they do, you tend to find a lot of sources of interesting ideas. And in today's age, because this regulatory requirement towards disclosure, I wouldn't be surprised you can really find a lot of great ideas just out of reading publicly available information. It is judging what is a good opportunity that is really difficult.
What does it look like if you finally develop a conviction in an idea? Is that kind of like an aha moment, or can you describe how you come to that conviction level?
Well, one of my favorite ways to describe the conviction of idea is that if you can find the most intelligent person who would oppose your idea, and you're able to argue more successfully than he does against your idea, that is when you can develop or entitled to some views. And even then, you want to really confine yourself to a small segment of things that you think you're right. And of course, as you gain more experiences, your circle tends to expand, but only small and gradually over time. So I think that being intellectually honest is a huge requirement of being a successful analyst and a successful investor.
Yes, thank you for coming today. I wanted to ask you a question about portfolio construction and just hear your comments on diversification. In the last session, there was a lot of discussion about diversification and the importance of it. My sense is that you're more of a concentrated investor. Some other investors are like that. Where does that, what kind of role does diversification play, or how do you think of it in building a portfolio?
Well, you always have to have some kind of a diversification because A, you could be wrong, and B, even if you're right, you're betting on statistics. In other words, the future is essentially a distribution of all probabilities. Say you have a 90% conviction, and you're right, that event is 90%, but then 10% chance it happened. And so you don't want 10% to get you out of the game. So you do need to diversification. On the other hand, that recognizing is extremely rare to find no-brainer great opportunities. Extremely rare. In fact, you have to wait for a long time before the fat pitch to come to you. So when that happens, you certainly do not want to diversify away the opportunity that you have been waiting patiently for a long time to discover for some really inferior other opportunities. So investment is essentially the opportunity cost. So one other alternative have to really justify itself by comparing with the one you already have. And so when you make that comparison, you tend not to really diversify too much. You would find a few very, very good ones that have a very high conviction and let it rise. And so, yes, you do a little bit of both.
So in that example, and you're kind of hitting precisely what I was getting at, in a very high conviction idea, what do you feel the limits are in terms of, how much you could be invested and what considerations do you have for that?
Well, I would say, as I said, that all decisions ought to be looked through the concept of opportunity cost. Is what else can I do with the cash I have? And cash, by the way, is really a fundamentally important asset. And if I don't really find anything else, or if I find a bunch of other opportunity inferior to cash, then I would keep it in cash. And so I would say that it never bothers cash if I can't find great opportunities. At the same time, when I find, say, one good idea, I'll let it be a little bit bigger percentage of the portfolio, and then everything else will compare with what I already have, which is cash. And sometimes holding cash can be the result of a bottom-up research. I always believe that's the case.